everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of ZANA Investments, Tim Little, and on today's show, we have with us Matt Dunn. Matt is the founder and owner of Right Move Properties, a real estate investment firm who specializes in the acquisition and leasing of underperforming multifamily assets in B and C class locations within Southwest Florida. Their primary focus is adding value via capital improvements and increasing overall efficiencies of properties. Since getting started in 2017, Matt has owned 142 units valued at over $17.8 million. Matt, welcome to the show.
Thank you, Tim. It's a pleasure to be here.
Yeah, and it's definitely great to have you. So I gave everyone a high-level overview of your background, but on this show, we really like to get down to the details of how you got started on your journey to multifamily millions. So please tell us a little bit more about yourself and what brought you into the multifamily space.
Yeah, absolutely. So for me, it started, as you can probably tell from my accent, or at least you will, I'm from the UK and actually was brought over to the US back in 2009 with my corporate career. Well, that was a great career and happy that brought me to the States, certainly into Florida, especially. Being from the UK, I did own a home. So I had a home that I bought in 2007, not the best of times to buy a home, admittedly, but that home actually I turned into a rental when I left. Anyway, I decided I wasn't planning on going back, didn't really cash flow that well. So I ended up selling that home in 2015. Well, 2016, I had a pretty decent tax refund actually come through from my CPA here. And for the first time in my life, I was like, I actually have some extra capital to deploy into something. And hadn't really been in that position before. I was always very much, putting extra into my 401k and IRAs and things like that, thinking I was being smart for retirement. But obviously that was maxed out and I didn't really want to continue that path. I'm like, well, what do people do? So I honestly went online and started researching what do people do with additional capital, investing wise. And a lot of it was coming down into real estate. And that's how I got involved. And like a lot of people, I started educating myself on bigger pockets, researching different asset classes. And it's, as we know, it's quite overwhelming. There's so many different strategies in this business. And I just kind of gravitated towards multifamily, mainly because I felt like a single family rental, when you've got that one vacant unit, you're 100% empty. And I didn't like that concept. I wanted the comfort of perhaps having 3 or 4 units because I was planning on buying something that needed a little bit of work. I've got a little bit of experience in renovations from the past, from a previous job when I was in college. So I kind of understood some of the nuts and bolts of renovations and I was comfortable with doing that. So I decided I was going to go after a 4 unit. So fast forward to 2017, I bought a 4 unit here in Tampa Bay. Used that capital I had from that refund as the down payment. And then I discovered through, again, bigger pockets, I'm like, there's this thing called a home equity line of credit. I can actually leverage my primary home equity, put that towards something else, not a boat or a fast car. I could actually put this towards the renovations of this property, right? So I ended up getting a pretty good line of credit, put that towards the reno. Spent about 9 months basically renovating that property, did a lot of the work myself, learned an absolute ton, learned how to deal with residents, how to deal with contractors, all the things that go into a project like that. And for me, it felt like a pretty big undertaking, that 4 unit. I still remember driving home from the closing, actually had this immense feeling of overwhelm. I'm now responsible for these 4 families. I was a little bit frightened of that, I suppose. And I've learned actually, just on a side note, when I experience those emotions now, I've learned to lean into them because that's where the growth comes from. And I hadn't really had that mindset in the past. So that was a definitely important lesson to me. So I recognize that when that happens now. But anyway, I was able to renovate, brought our rents from $650 average up to $1,100 in the course of a year. So suddenly I'm like, wow, this is amazing. Then I was able to do a cash out refinance, pulled out all of that money on the renovations to pay my HELOC back to 0. So at that point, I'm like, wow, this works. I've now got little money in this deal. I'm making over $1,000 in cash flow a month. And that was my plan. I'm just going to go out and buy a bunch more of these properties and I'll be good to go, right? Well, it proved to be a little bit more difficult to find more deals. Back then, believe it or not, my criteria for cash on cash was 12% or higher. That's the deals that you were actually able to get back then. Now I'm like at 7. It's almost, but that's just the cycle we're in right now. So I decided I was going to pivot into commercial multifamily. I started listening to more sophisticated podcasts that was focused on syndications and learned about the value add approach. Ended up going to a multifamily boot camp in early 2019, which is where you and I actually met, Tim, and ended up doing a 59 unit syndication with yourself and some other partners that I'd met through the community. That was in Tampa as well. So that was, again, a phenomenal experience. I was kind of brought into that team, and it's important that you add value when you're getting started. I had experience of that asset management, dealing with contractors. I was kind of brought into that deal to vet PMs and identify a good PM for that project. So I think that's definitely a good thing to think about if you're getting started, is where do you fit into a team? Partnerships are so critical. But that year was busy. 2019, I bought a triplex as well, which arguably was a bit of a sidebar deal. It was just a good price that an agent brought to me that I knew would perform pretty well. And then I definitely got the shiny penny again later that year and bought a 5-bedroom, 3-bath cabin in the Smoky Mountains of Tennessee. I could spend this entire podcast talking about short-term rentals. I won't do that. But that one actually cash flows tremendously well. But it did take me about 6 months to get that one off the ground, and definitely thankful for that asset. That was definitely a key element to allowing me to quit my W-2, which happened in 2020. So in the summer of 2020, I put my notice into my employer because we were at a point where we actually had enough passive cash flow to cover our expenses, not our income, our expenses. So that was our goal at that time. And we decided with COVID and everything, we were going to hit the road. So we actually just got back 2 months ago from traveling 2 years in a RV across country. So we did about 35 states, 20 national parks, and we just got back. Believe it or not, I was doing deals over that period. So I spent late 2020, I actually joined a mentorship program focused specifically on multifamily investing, and ended up buying in 2021 an 8-unit in Fort Myers. I then JV'd a 16-unit in Gainesville later that year. And then this year, I JV'd a 24-unit in Alabama, JV'd another 24-unit here in April in East Tennessee. And all of those past 3 JVs have been with folks I've met through my mentorship program as well. So at the moment, I'm actually looking to pivot back to a syndication. That's my focus right now, looking for around 20 to 120 doors, within the Southwest Florida here. So that's where I'm at right now.
Wow, so much to unpack there. Okay, so first, I would be remiss if I didn't hit on your former employer, if you're at liberty to disclose who they are, just because I think it's cool. All right?
Absolutely. Sure. Yeah, no, I work for Rolls-Royce Motor Cars.
Yes. So as we all know, they are quite posh. And I think we all just make the assumption that when you work for Rolls-Royce, you obviously get a company vehicle, right? You were rolling around in a Phantom. Is that right?
No, I was in a BMW, but it was still
Well,
nice.
yes, still nice, still nice. No, that would have been a nice perk though. So yeah, it sounds like you've done and I don't mean this in a disparaging way, like a little bit of everything, really trying to find what was, your niche, I guess is the best way to put it. And that's how a lot of us do it. Some people, they get too bogged down in the analysis piece that they never try anything. You kind of went the opposite route, and you did try the short-term rental. You did try the small multifamily, also did joint venturing, which you've obviously found tremendous success in. And I'll get into that in a second. But key point for me is that you took action. Yeah, there's a little bit of the shiny penny syndrome there, but sometimes the best way to evaluate those things is to just jump in. And if the numbers make sense, then I think that's okay. What are your thoughts on that?
I completely agree. Yeah, I definitely am one to take some risks in life. My previous job, when I was working in the UK, they used to send me into these really somewhat uncomfortable situations with meeting customers in all parts of the world, Eastern Europe, all over Asia, to work on these Rolls Royces. And that really kind of tests your comfort, I suppose. So I've learned from that really changed me as a person. And now, like I say, lean into those situations more. And if I see there's potential, even if there's a potential for a failure, I think that's okay, because I've found that I'll learn a lot more from failure than I will from just reading a book or a concept.
Yeah, absolutely. And in terms of how you got started, it sounds like you had a similar start to me. And I think a lot of people that get into this space, most people, I would probably argue, go with the single family, right? Because it's what they know. They've owned a house, they've lived in a house, they understand it. But others like you and I, we see the risks involved with having either 100% occupancy or 0% occupancy. There's no in between when it comes to that single family house. So that's also why the first investment property that I bought was duplex, right? It was just a way to at least slightly mitigate that concern. So even if I had one side rented out, the other side may be empty, at least I have 50% of the income coming in, and that 50% could make the difference on whether I was able to pay that mortgage or not. And I think a lot of people need to think about that, especially if they're considering jumping into single family first. Now, if you live there and move, okay, that's one thing. But if you're talking about buying your first investment property, I would really heavily consider people look at either duplexes, triplexes, quads, whatever is available to them and whatever they can afford, just because the risks are significantly lower, I would argue.
Yeah, and that's certainly a lot less. The single family, you can go in perhaps with a little bit less on the capital side, but you spend less on the purchase you're going to need in reserves for that potential vacancy factor. And I think the other thing to consider is with the single family space, if your plan is to continue buying those homes, unless you're buying in a really good community, then the costs really mount up and you need to send a maintenance repair person out to do certain things. If it's not at one building, there's not the economy of scale there, and it can really cost a lot more on the repair side. So you need to have a lot more reserves.
Yeah, absolutely. And then, of course, those economies of scale just increase exponentially as you move up that property ladder from the small multifamily to the commercial multifamily. Going in your next step, it sounds like, was the next step the JVing or was it the syndication in Tampa?
It actually was the syndication. So I did my first syndication once I decided I was going to go commercial multifamily.
Okay. And like you, I thought it was a great learning experience. And that was a deal that we could say that we've gone full cycle on, which is a big accomplishment, right? To finally get that legitimacy of having gone full cycle on a deal. It's just funny that so many of us were relatively new to the space and we were just determined. That determination allowed a big group of people to just take down a deal, even though a lot of us didn't have necessarily the requisite experience or anything going into it. And a lot of us have been pretty successful in the meantime. And it all started with a group of guys, in this case, getting together and saying, hey, we want to do this. We'll figure it out. We all have varying skills, but let's apply those skills so that we can see success on this one thing and then take
Mhm.
it from there.
Yeah, that was an enormous point to make because I feel like that adds credibility to your resume moving forward. I think having that foresight to believe, okay, perhaps the amount of returns in that deal may not be where we originally expecting, but I think the payoff for a deal like that to get you in the game, to now have that on your resume when you're talking to brokers, lenders, potential investors, they see you've done this before, you've got agency lending experience, that's huge. So it's definitely massive benefit when you've got that. That's really propelled me into instant credibility when I've gone to a bank or gone to even a seller and explained. And I actually have a bio that I provide with every single offer that I submit to a broker or a seller direct. And I think that one kind of really sticks out as being definitely a big win because of not only the full cycle, but it was a larger deal that I've done.
Yeah, and that's something that I try to get across to, especially aspiring syndicators. If you're coming into this, not everybody wants to do that, and that's fine. But if you do want to be a syndicator, then just don't be greedy on especially on your first deal. I came into it with a really, really small slice of equity, but for me, the real value was being on that team, being able to learn the process, everything that goes on, learn the right questions to ask, and also being able to say that I was a GP on a deal, a general partner on a deal. It adds a level of legitimacy, like you said, when you start to look at other deals in the future. And it can be the thing, the catalyst that kind of kickstarts your entry into this space. So again, I just Forward aspiring syndicators, don't be greedy. Don't worry about how much money you're getting paid for that first deal. Worry about getting in the deal. I think that's the most important aspect.
Yep, because more deals will come. Exactly.
Yeah. And so let's talk about the JV piece because I am interested in that. I have not done any joint ventures up to this point. I know we've talked about we should probably go ahead and do one at some point because I would like to invest here in Florida as much as possible. Talk to me about what those first JV deals look like, how they were structured, and how you really approached the partnership aspect. How did you evaluate those partners and ensure that they were a right fit for you, your
Mm.
values, and your business goals?
Yeah, you hit the nail on the head with values. So that's critical. So, like I mentioned, I joined a mentorship program late 2020, and every week I would purposely network with people in that community. There's over 1,000 people in there, and they've all got different locations, different values. And my coach actually gave me a excellent exercise when I first started, and that was to define my own core values, which I'd never done before. So figuring out what are my family values, what kind of deal is going to fit with my lifestyle, right? Because you can go do a deal, but if it's going to consume 40 hours a week, maybe that doesn't fit with your work-life balance and your family, right? You might as well just go back to your job. So that was an exercise that really taught me a lot. And then from there, you need to work out, do my core values align well with who I'm potentially talking with here? And could we be potential partners? For the JV, I guess my kind of cutoff for the amount of people in a JV is a maximum of 5 GPs, mainly because the returns really get diluted a little bit too much if you go above that. So that's kind of my standard. But the questions you want to be asking potential partners are, what's your preferred hold period? Oftentimes in a JV, it's perhaps more of a longer term hold than a syndication. Syndications are normally 5, perhaps 7 years. And then there's a refi component in there as well quite often. JV could be potentially longer than that. So that's always a question I will ask early on. If a person brings me a deal, they're interested in having me come in on, or if I am bringing a deal with someone else, I'm like, this is going to be potentially an indefinite hold. Are you okay with that? That's very important because a lot of people are perhaps used to, if they've come from the LP side, they want that capital back to redeploy into another deal in, say, 5 years. So, and then with that comes a conversation about a bit more personal things like family, and are they going to want to create a legacy for their children down the road, things of that nature, because that's kind of my goal. I don't want to give them properties, but I want to give them the tools to be able to create, to continue creating legacy wealth for their grandchildren and things like that. So just having those more, I suppose, deeper conversations has been helpful to see you align well. And then one thing I do as well, depending on your circle of potential investors, I typically will use a dollar cutoff. So if I'm looking at a deal that has a raise amount of typically between 1 and 1.5 million, if it's below that, then I think a JV is very doable between 5 people, right? If you can find some partners that are bringing in a couple 100,000 each, then it's very doable. But any more than that 1.5, you're going to kind of struggle, and it would make more sense to syndicate at that point. Plus, don't forget, everybody needs that active role within the JV as well. So, that's an important factor to not have too many people.
Yeah, and that's a key point that people I think sometimes forget that you have to hold to that. So I guess within the JVs that you've been a part of, what has been your role in those deals? And give us an idea of some of the other main roles that you see amongst the partners.
Yeah, absolutely. Great question. So my first JV was that 16 unit in Gainesville. I was actually brought in on that because I had lending experience. So I was familiar with working with lenders and what they needed. I had the net worth requirement to support the deal, and I'd closed the deal just a few months beforehand. So I was actually fairly up to speed. The gentleman that got presented the deal, this was his first deal actually. So he was a little bit newer, and him and I had already discussed doing potential deals together anyway. So we had a conversation about it, and we actually both underwrite very similarly as well, which I think is quite important when you come together. And I work in acquisitions now, that's kind of my focus, but that involves underwriting, as is this particular partner. So we both kind of overlapped a little bit, but really from that deal, it was more assistant asset management and also support for the net worth and the underwriting piece. The next deal I did a couple months later was a 24 unit in Alabama. That one I actually got brought in as more of a consulting capacity. Again, this was for another student from the mentorship program. Again, this was his first deal. And he'd seen I just closed a deal recently, and he was like, hey, I'd be really interested if you could take a look at the deal and, come in, with me on it, because you've got that experience. And this was actually going to be a bridge deal as well, which he hadn't done before, and I had that experience. So I was kind of more of a consultant capacity, but obviously I am active in that deal as well. Have a pretty small amount of equity in it, but that was kind of how that one worked. And then the most recent deal in East Tennessee, I actually was the one that found that one. So I was the lead acquisition. I had the broker relationship already from some conferences I'd attended up there. And so I actually found the deal. I underwrote it, put the team together. So I guess you could say what I don't do, it's probably easier for me to answer, is I don't asset manage anymore. Decided that's not a good fit for me. It doesn't work for my work-life balance. I like to have more flexibility because I love traveling. Clearly we spent 2 years on the road, so you wouldn't be able to asset manage if you're going to do that kind of thing. I like being on the front end of a deal. I like being in the field. I like finding the deals, dealing with brokers. I like the underwriting, putting the offers in. Capital raising, I haven't really thought about doing that. I may pivot to that perhaps in the future, or potentially a KP role as well. But for now, that's kind of where I fit.
No, that's great. It's nice that you've been able to take part in those different roles, because I think it makes you more well-rounded, obviously, when you're doing that stuff and getting that experience, and people are recognizing that experience that you have and bringing you in. I guess another question that I have, again, because I haven't done JV myself, and I think people really need to understand this. What is the difference that you've seen in terms of the splits when it comes to like the difference between the amount of equity that you're getting doing a JV deal and a syndication deal? Because in a syndication deal, investors are putting in most of the money. So rightfully, they're getting the largest chunk of equity. Can you tell me what the difference is between that?
Yeah, that's a good question. So we actually have a JV underwriting tool, which answers that question quite well. So you can purely put in the amount of equity, the amount of capital each person is putting into that deal, because it is not a syndication calculator. It's a joint venture calculator. So it doesn't have the pref, doesn't have those parameters built in. But what it does do is allow you to clearly see, okay, well, if I'm putting 150,000 into this deal, this is the amount of equity from a dollar standpoint that I would be potentially entitled to, I suppose. Now, then you would tweak that depending on what your role is, and you can start I use a bucket system as well. So, you can then figure out, okay, well, who found the deal, who's got the risk capital component, who's doing the asset management, and you can kind of refine that a little bit more. So that's how we've been able to do it. And this last one, actually, in East Tennessee, we split it down the middle. We all have 20% apiece, and that just made it easy. And I found the deal, I got it into contract, and basically got it across the finish line. So my capital piece in that is less, but then, had it not been for that important piece, we wouldn't have got the deal in the first place. So that's a good way of actually getting into a deal if you're able to add that kind of value and you're in a market that, that it does well, where there are deals.
Yeah, and I think it's just important that, again, new syndicators understand the differences, and not that necessarily one is better than the other, but you certainly have the scale with these large 100+ unit syndications. So if you're only getting 2%, that may sound menial, but again, if you're talking a $20 million deal, it's still a nice chunk of change. And then counter to that, if you're on a JV, it may only be a couple $1 million acquisition, but you're getting 20% instead of that smaller amount. So I think it's just different dynamics, and whether you want to deal with that capital raise aspect and stuff like that. So there are certainly differences in how they're run and how you raise and close them. But I don't want people to be fooled into thinking that you can only make good money in syndications and vice versa with JV deals.
Yeah, no, 100%. And honestly, the closing costs tend to be a little bit less on the JV. You don't have the attorney fees to deal with. Now, one thing I will say is, majority of the time, those investors, those GP partners in the JVs are all going to be, it's a recourse loan. So they all have to sign on the loan. So it's important. So unlike a syndication where you can basically get the deal in contract and start raising, and you have that time on your side, right, to bring investors in, because the the limited partners, the bank doesn't necessarily need that information up front. A JV is the opposite of that. So that can cause some concerns if you don't have your ducks in a row and have all your investors lined up when you're getting that lending piece put together, because the lender won't be able to fund it or even really begin underwriting until they have all of those partners. Because anyone over 20% equity needs to be on that loan. So that's an important piece to think about.
No, that is good. I appreciate that. All right. So you spoke about the 2 years you spent on the road, and I think that's important to hit on because so many people talk about the reason for investing, or if they decide to go the syndication route, whatever the case may be, it's because they want more time freedom. They want to get back more of their time. And some people have this notion of leaving their W-2 job to do multifamily full time or to be a passive investor full time. And I'm in the same boat. So I'm certainly not going to criticize that. But I think sometimes we tend to glamorize that, and it's not all rainbows and butterflies. So I'd certainly be interested to hear your practical experience when it came to transitioning away from your W-2 job into investing full time, and what, if any, challenges you faced with that. And did you have a plan going into it?
Yeah, no, I definitely can talk to that quite well. So it was like a vacation when I first left my W-2. And it's interesting because you spend a lot of time thinking about how you're going to feel when you hit this massive milestone, which is in your mind, right? You've been in this job for potentially decades, and that's the big why. But it certainly was for me to exit that W-2. Well, I mean, yeah, it was definitely a neat day and we celebrated, but it wasn't the elation and tremendous sensation of achievement that I was expecting. We spent that time traveling shortly after, and honestly, it was like a vacation. I worked for a long time, so you suddenly just feel differently when you've left. So I felt like I was on just an extended vacation, which lasted about 3 to 4 months, I would say. And at that time, I started to feel like, you know what? I've got a lot of potential here, and I'm not fulfilling that. And I felt like I was not fulfilling where I needed to be. And it was interesting. My wife could tell that I was getting a little bit, I suppose, frustrated on that. I wanted to do something, but wasn't sure what. So she said, hey, we were driving actually back from Mount Rainier in Washington State late one evening. And she said to me, hey, have you thought about looking at getting coaching? And I said, are you kidding me? I said, coaches are very expensive. That's not something that I would ever consider. And, she said, no, I think you would definitely benefit from it. And, kudos to her. She was 100% right. So I started looking at different coaching programs and found one I felt met my values. And I knew already that I liked the more of the legacy wealth concept. I feel like sometimes on the syndication side, don't get me wrong, it's an excellent strategy and definitely continuing to do more of those. But it can be a little bit more transactional, and it's kind of like flipping houses, right? It's quite active, and then you continue to keep having to do that to earn. So I knew that I had to find a coaching program that was perhaps more focused on that long-term legacy concept. But yeah, so once I got into that, that's when I started really feeling like, okay, this is where I belong. And don't get me wrong, it's quite tough working a business like that when you're traveling, especially seeing such cool things that we saw. Because you want to see the things, but you also want to work. And you have to have a really disciplined time schedule to make sure that you're spending the time in the right places to be effective.
Yeah, and I remember on multiple occasions having meetings with you and just, seeing mountains in the background or lakes and just being like, so Matt, where are you at today? So it was always like a fun little game for us too, to figure out where you were that day because you were driving around to so many different places.
Exactly. And finding internet was always a challenge. So don't miss that part.
Yeah, I can't imagine trying to run my business from an RV, but kudos to you for making it happen as long as you did. But I think you hit on a really key point that, people think that they just want to quit their job and that's it. But I think a lot of people find, like, one, they're either bored, or two, unfulfilled. Like you mentioned, they know what they're capable of, and it's not enough to just sit around or travel like those things are very rewarding in and of themselves, but there's always something more if you know that you're capable of it. And I think that's when people get, I don't know if frustrated is the right word, but that feeling of not being fulfilled, of not doing what you know you're capable of, it can really start to weigh down on you. and you have to break out. And it sounds like that's what you did.
100%. Yep.
Yeah. So, hey, this has been a great conversation and I would love to continue it more. But right now, we need to move on to the turbo round. So, I am going to ask you 3 questions that I asked every guest in quick succession, and I'll just ask you for your honest answer. The first is, what is the one red flag every investor should look out for? And that could be either passive or active investor.
Yeah, so this actually happened to me recently, and so I can talk to this one quite well. It's not sharing the underwriting. So if you've got even a GP or an LP position, doesn't matter. If you're looking to work with the team and there's perhaps already a deal in contract and they've established it's going to be a good deal, if they're not willing to share that underwriting with you, then that would be a really, really big red flag. Now, I understand if the operator is concerned that you may go out and ask for the T12 and the rent roll and you want to redo the entire underwriting, and they're going to be concerned that you perhaps are going to not agree with their assumptions. That's overkill. You don't need to be doing that. So whoever you pick as your potential operator, there needs to be some kind of element of trust that the operator has experience in that asset class, that market. You trust the business plan that they're doing. If you have those doubts going in, you shouldn't be investing with them in the first place.
Yeah, that makes a lot of sense. And I would say they should certainly show you the underwriting, but in addition to that, I think they should be forthcoming with whatever their assumptions were that are baked into that underwriting as well, because that's really key to understanding, is this person underwriting this deal conservatively?
I agree. Mm-hmm.
So the next question, what is a myth about this business that you would like to set straight?
Yeah, you hear this a lot, the fact that you need the capital to get started. The fact of the matter is, I think you need to start with adding value. You can definitely get into this business by surrounding yourself with the right people. And that's really where you have to start, is getting around the right peer group, adding value to those that you meet. And you'll find not only where you fit in the business and where you're strong, but you'll also see if you get brought in, you can be boots on the ground, you can go and look at deals, you can tour, especially if you live in a market where there's deal flow, right? So that's huge, especially for folks like us. We're in a strong market here where people are moving to and job growth. So I feel like you and I have got that advantage, certainly, to be able to add that value to others. So don't think just because you perhaps don't have the money, you have to wait till you've saved. Get out there, start meeting others, get on Zoom calls, go to conferences, and start networking.
Absolutely. Couldn't agree more. And the final question, what does success look like to you?
I think gratitude is huge. So I have a hard time being present quite often on a daily basis. So I have to consciously always remember how fortunate we are to be where we live and everything we have around us. And that's the work in progress for sure. And what we touched on with that fulfillment is continuing to learn, striving to be a better person, a better father, husband, adding value to others without expecting anything in return. And like I said, I learned a lot. You're not suddenly going to hit that magic milestone or achievement and you're going to feel successful. It's a continuous daily growth that defines your success. And that's something I'm still working on. And that I feel like once I figure that out 100%, then that will define my success.
Yeah, that's so true. And something we hear from a lot of guests on the show, that continuous improvement piece. And when you do hit milestones, it's okay to celebrate them, but most people don't find satisfaction. Like that's not the end point, right? Because this whole thing is a journey. So I think we relish in every step, but there's no finish line.
100%.
All right. Well, hey, Matt, it's really been great having you on. Please tell our guests how they can get a hold of you and if you have anything else that you would like to share with them.
Yeah, absolutely. So you can reach me directly at Matthew, 2 T's, at rightmoveproperties.net. My direct phone number is 941-504-0548. And then our website is rightmoveproperties.net.
Okay. We'll have all that information in the show notes. I definitely appreciate you coming on and look forward to seeing you do big things on your journey to multifamily millions.
Thank you, Tim. It was a pleasure. Take care.
Thank you.